So today, yes, I will start with a kind of an economic outlook where we think the world is at and where we think we're headed. I'll focus in a little bit on challenges with respect to labor markets, and this is, I think, a really important issue for Canada, especially as we look forward. And I think we're already feeling some of the stresses and pains of that tightening labor market. So I will focus in a little bit more on that. And then later on in the morning, we'll focus on our, I guess, some preliminary work and research that we've done around CETA. So I'm going to start essentially this first session on the economy. I've got a lot of data for you, but hopefully it'll be enlightening. And near the end of the, I guess at the end of this first session, we'll have a question period if there's anything that anybody wants to ask, or if there's anything along the way where you really feel you need to stop me and you want me to elucidate a little bit more, I think we can accommodate that as well. So let me start by just a kind of global snapshot and what's going on. I think it's really important to put things in perspective. When we start hearing, especially when we see what's happened over the last few weeks with respect to bond markets in Europe, equity markets, and some of this decline in oil prices that we've seen, a lot of concern now around the global economy, a lot of negative talk, I guess, from the newspapers. And I have to say that when I read the newspapers and when I read the economic pieces of the newspapers, I don't know about everything else, but it seems to me that we often take little bits of data and make big statements around them. Fundamentally, I think the news is pretty good in terms of the economic outlook. When we look at the situation for, with respect to oil prices that we've just discussed, a lot of concern around that, but essentially lower oil prices are a good thing for the major drivers of the global economy. When we talk about the US, Japan, or even China, for example, those are all economies that are still very much net importers of energy, and lower oil prices tend to have a positive impact on those economies. U.S. consumers today are facing gasoline prices that are running around $3.10 a gallon, down from about $4 a gallon. A huge amount of income back into their pockets to drive that economy. So when we talk about again, those big drivers, the U.S. economy is looking fairly good. I'll talk to that a little bit more later. Japan, still the number 3 economy in the world. Lots of things going on there. Still lots of concern, I would suggest, with respect to President Abe's latest reforms. But if you look at the forecasts for 2015, essentially in Japan, they're still quite positive. Business investment intentions are still good. The consumers suffered a little bit of a setback after a major tax increase, but we do think that Japan is in pretty good shape. At least they've licked deflation in that economy. I'll get to China in a second. I think the biggest concern still is around the European Union, and of course this is the short-term concerns that we have with respect to the financial crisis, with respect to all of those sovereign debt issues. They've come back to haunt us a little bit. And again, if we go back just a couple of weeks, it was jitters in the bond markets around some of these sovereign debts in some of the southern European countries that got the whole thing going again. So we're reliving some of these jitters that we've had since the 2008-2009 recession. I guess the big problem for the EU is really the structural reforms. We haven't seen enough structural reforms put in place to really see that region drive itself out of some of the problems that it has. Let me just talk about BRIC. We don't really hear the word BRIC so much anymore. That is Brazil, Russia, India, China. And that is because they are so divergent now in terms of their performance. When we think about Brazil and Russia, for example, those are 2 economies that did extremely well during the 2000s because they won the lottery. Much like Canada, they are resource-based economies, and with raw material prices taking off as they did through the 2000s, those 2 economies had a huge injection of income, which they spent very quickly, and we saw a lot of growth in those economies because of this fiscal stimulus and very generous programs that were put in place both in Russia and in Brazil. Not a lot of focus on direct investment, infrastructure investment, or promoting FDI investment into those economies. And this is why we're seeing now some weakness in terms of both Brazil and Russia. And of course, on top of that, Russia is suffering from the effects of sanctions, all sorts of trade sanctions. Foreign direct investment has left the country rapidly, and the Russians have recently had to spur up interest rates to keep inflation from taking off. So Russia in real trouble. But when I think about China in particular, and again, I go back to those headlines that we always read. When we hear about China, we're always concerned, and this has been going on for a decade, we're always concerned either about deflation in that, overinflation in that country, or a steep slowdown, right? A hard landing in China. But if you look at the track record in China, for 10 years now, solid growth of 9% in real terms, inflation-adjusted growth, 10% for a decade. What that means is that today, China's economy is 2.5 times the size of what it was back in 2000. And that means that 7% growth on a much, much bigger base is a bigger contribution to global demand than it ever was in the 2000s. So China's economy, again, it's not a perfect free market system, state-owned enterprises, state-owned banks, but they have managed extremely well to move that economy into an economy of growth, to move as well from an economy of industrial production and manufacturing and exports to an economy that is now driven by domestic demand. So consumers are becoming a bigger and bigger part of that economy. So I'm a big believer in China, and if you believe in China, and I'm going to convince you, I hope, that the U.S. economy is also in good shape. Those are the 1 and 2 economies in the world that are heading into 2015 with pretty good growth prospects. So, you know, if you read the Globe, there's a cartoon called Cornered, a little comic strip, and this came up about a month ago, and I saw myself in the picture. It was this market analyst talking to the crowd and had a chart up, and underneath it said, "There's a lot of uncertainty out there." Or not, who knows, and sometimes I feel that way. Certainly when we look at the fundamentals, lots of positives, but when we get down into the kind of geopolitics of it all, you know, and economics is not a pure science. It is you know, a little bit of art and science mixed together, and there's a lot of assumptions that we have to put into our forecasts around stability around many of these issues. So many of these things can derail certainly our outlook, but the point is that I think fundamentals are still pretty good. So let's just quickly go to the U.S. You know, a big economy, one that has essentially not seen a full-out recovery since the recession in 2008, 2009. If you look to past recessions, once the recession is over, usually we would expect to see the U.S. recover at a pace of 4.5%, 5% growth as it catches up on what it's lost in those couple of years. What we've seen instead in the U.S. is this very slow and troubled recovery because of the effects of this financial crisis on household wealth and on business confidence. You've probably heard some of the central bank governors talking about how much cash there is available to businesses in both Canada and the U.S., how businesses are leery of spending. I think that's very much true. Businesses have have become very essentially frightened by the financial crisis, and they've been, to this day, keeping a lot of their financial books with a lot of cash in hand, much more cash in hand than they used to. But nonetheless, this means that there is money available for investment and for job creation, and we're starting to see that emerge. And why? Well, the reason is the fundamentals are getting better and better for the U.S. If you look at the cost of labor in the U.S., unit labor costs have become very advantageous in that economy, especially compared to Canada. We've seen our currency appreciate very strongly, low productivity performance here in Canada. The U.S. has been just the opposite, very, very strong productivity gains. Wage increases have been very moderate since the recession. They have a soft labor market, partly to explain that. In terms of the energy costs, another big input into your production, energy costs are pretty much the cheapest in the world in the U.S., not just because of oil, West Texas Intermediate, which is a little lower than Brent and then is now getting even lower, but also because of natural gas. Natural gas prices are a substitute for electricity, and so that's been keeping energy costs very low. The final factor is the consumer. The consumer has deleveraged out of debt, employment is picking up, wages are picking up, and we're seeing a revival in consumer spending, both in the auto sector, in real estate, and others. So if the demand is there, the U.S. consumer is, as you know, 75% of the U.S. economy. The U.S. economy is a quarter of the world. So the U.S. consumer is a powerhouse in terms of world demand, right there in the U.S., within the U.S. borders. And that is essentially driving back investment. So all of these conditions, the demand being local, low energy and manufacturing costs and production costs, is driving back investment into the U.S. economy. So this reshoring effect is very real in the U.S. economy. And in fact, we're having trouble competing with the Americans on that front. We're seeing a lot of investment forego Canada, going back to the southern U.S. And Mexico. So there's the forecast we have for real GDP growth in the U.S. As you can see, very timid growth since the recession, running just a little bit above 2% on average. In the first quarter of 2014, we had that polar vortex we sent down to the Americans. That froze up GDP growth, but the second quarter came roaring back. The third quarter is above 3%. So second quarter is close to 5%. Third quarter at 3%. That means that built-in growth for next year is well on its way to 3%. It's not it's not a hopeful prayer here to have growth in 2015 at above 3% in the U.S. And that is a fundamental piece of the outlook for Canada and for the global economy. Now for Canada, very different picture. And what I'd like to say is that, again, in Canada now, we often hear about the performance of the economy over the last couple of years, how disappointing it's been. We've seen growth at under 2% or just about 2%. That's been very disappointing. We've seen employment growth at 1.5%, 1.3%, and that's been very disappointing. Well, what I say to people is that 2% is pretty much the new normal. This is the fundamental, what we call potential growth of Canada's economy going forward. And I'll talk a little bit more about that later. But it's true that we may have a year or two where economic growth will get above 2%. We're going to catch up on those losses. We're not at full employment yet. So we have a couple of years where we do expect growth to get a little bit above that. But the new normal going forward is pretty much a 2% pace for the economy. Fiscal restraint, that's a big story, and I don't have a lot on it today, but if there's any questions on that, we can certainly dig into it. But essentially, if you look at provincial budgets across the country, we're in fiscal restraint mode till 2017, 2018. If you look at central Canada in particular, we're in fiscal restraint mode till then, and it gets even steeper in terms of the cutbacks in 2017-18 to achieve those balanced budgets. A little bit of wishful thinking, if you'd like, in some of the planning on the provincial side. And the issue there is, of course, slower economic growth, coupled with an aging demography that is costing us more and more in terms of healthcare. So we've had success for a couple of years on healthcare spending. It's going to be tough to maintain healthcare spending essentially tight over the medium term. Rising rates. Our new governor has been much less hawkish about interest rates, and now we're essentially seeing rates rise in tandem with those in the U.S., so not any additional pressure on our currency. And rates will only come up probably in mid-2015 is when we're looking at, essentially for both the U.S. and Canada. Business investment in Canada, very disappointing actually. And investment did come roaring back after the recession. A lot of resource sector investment came back, and currently we're at fairly high levels. We're above those peak spending levels in terms of investment that we saw in 2007, 2008. But still, it has been a bit disappointing in 2013. 2014, we actually had a decline in overall business investment in Canada, and I think some of you probably are aware of that. You know, I think we've been waiting a long time for the U.S. recovery, and I think Canadian businesses have been gotten a little tired of waiting. Our domestic economy has been fairly solid, and now hopefully as the U.S. economy starts to recover more strongly, we'll see that business investment take off. And labor markets I'll talk about in a minute. Exports, just one note on that is that, you know, again, we were waiting to ride kind of the coattails of the U.S. economy. We hadn't seen much of a performance up until the second quarter. So in quarter two of 2014, this is the latest data point we have seen finally us taking off in terms of especially the non-resource side of the economy. So manufactured goods, machinery and equipment, other export strength to the U.S. So that's been positive in the second quarter. So there's our real GDP growth. Again, 2011, 2012, 2013, we keep hearing the news, that's very disappointing. I say, well, that's pretty much what we should expect. In 2015, as you can see, we closed the gap on full employment, on our potential, but thereafter, when we get to the medium and longer term, we're really looking at an economy that's not going to grow above 2% on a consistent basis. Now here's the lottery win. And it's always harder to convince people in Ontario about the lottery win because, of course, we're not so dependent on the resource sector here. But in Canada, we essentially saw the price of raw materials, the price of those things that we sell to the rest of the world, simply increasing by over 10% a year through most of the 2000s. So it was just essentially an injection of income into our country. It's not that we became a resource economy, by the way. We were, through this period, investing very heavily in the resource sector, but it takes a long time to get some of these resource projects up into production. So through this whole period, through the 2000s, it was essentially this income boost that was trickling down across all segments of the economy, not really in terms of production of resources. What we are seeing now going forward is all of that capacity is finally coming to fruition. So the resource sector is starting to add to growth in terms of the volume of stuff that we produce, but the prices are still profitable, just a little more stability in terms of the prices going forward. So we're in a very good position in terms of our overall export gains. Now here you see energy versus non-energy in volumes, in real terms, so inflation adjusted, and you can see the success that we've had on the energy side, but when we look at the non-energy, very different story there. And that story is essentially the restructuring in the manufacturing sector. So a lot of the businesses that we used to rely on, a lot of the manufacturing sector that we used to rely on to drive up growth has not really done very well through this period. And as we look ahead, you can see that last point in 2014, that's the second quarter increase that happened, very strong growth. And as we look ahead, we will see some gains in line with a stronger U.S. economy. Now this is a brave forecast for an economist. It's the oil price forecast up there. Very volatile item, but one that often drives the value of our currency. And so you can see that the dollar, essentially at a 60-cent dollar, a 65-cent dollar, we were able to produce a lot in terms of manufacturing and at a very cheap price. With the income effect of the raw material prices, we've seen that show up in terms of the appreciation in the currency. So a currency that's 60, 70% higher than what it used to be has posed a real challenge in terms of our economy. But what I would suggest is that our manufacturing sector was going through a restructuring anyways. We're not going to be able to compete with some of these low-cost producers in terms of labor-intensive manufacturing. So our economy has transitioned over this period, and I'm going to talk a little bit about why in a moment. The other thing that I would like to mention here is that as we look ahead, we do see, again, that stronger global economy coming from the US, China, Japan, those economies will help strengthen or at least maintain resource prices. That means that we should expect the currency to stay fairly strong. It's come off a bit lately. We've seen some hiccups with respect to some statements that were made with respect to oil prices recently, but I think the fundamentals are there that will maintain resource prices and raw material prices up and profitable for Canada. But this is what's happened to our price of labor relative to the US. We've essentially, because of the currency and of course our lack of productivity growth has not helped, but it's really been because of the dollar that we've seen the cost of labor in Canada really increase, skyrocket, in fact, with respect to the US economy over this period. So it has become a challenge. And when people tell me, yes, well, that's been a problem because now we've become a resource economy, I like to point them to this chart. And essentially, the restructuring that's happened has taken away from manufacturing, but where we've seen growth has not been in the resource sector. If you look at the primary sector, it's a very productive, highly capital-intensive sector, creates very few jobs. So you only need a few people employed in that sector to create lots of output. We have seen that restructuring manufacturing. In fact, we've seen over 500,000 job losses in Canada since 2004, essentially. But where we've seen the gains has not been in the primary sector, it's been in the service sector, the service side of the economy. And that's why when we talk about CETA later, we're going to focus in a little bit on that. So if you look at the total cumulative number of jobs that we've created over the past decade, about 2.4 million jobs. And if you sum up the bars, you'll get to 2.4 million. And in fact, all you need to do is sum up health, education, public administration. So that's the public sector. And that includes public administration as well as what we call commercial services. So anything to do with social services, education, and healthcare. Big growth in those components. The other piece, 1.4 million jobs, has been in commercial services. Commercial services is business services. It's essentially the businesses you guys are in, and that's where we've seen, and others, many others, retail, et cetera, and that's where we've seen all the growth. So here's that restructuring. And yes, we have lost 560,000 jobs, if I'm not mistaken, in the manufacturing side. A restructuring, by the way, that started in 2004 in Canada, but started well ahead of us in both Mexico and the US. In fact, their restructuring preceded ours, and it was equivalent, even though they didn't see the same kind of appreciation in their currency versus the US dollar. It's essentially China coming into the scene and other low-cost producers coming into the scene. We cannot compete on labor-intensive manufacturing. And if you look ahead at our forecast, it doesn't mean that we can't produce manufactured goods in Canada. It's just the type of manufacturing jobs are very different. We're not going to be able to see job growth in terms of people on the lines as we used to see. We just can't compete on that. And that's why that investment right now is going south. It's going south to Mexico. It's going south to the US. But again, lots of big subsidies happening there to encourage some of that investment going south. But what's interesting is where we have had success, and that's in professional and other services. So I often hear this other tangent, which is if we're losing manufacturing jobs, then that means that we're gaining these jobs in retail and other service sectors that are low pay, et cetera. And that's not true. This is on the same scale, by the way. So we've gained almost as many jobs on what's called professional, scientific, and other professional services. We've gained almost as many jobs in those categories, high-paid jobs, as we've lost in manufacturing. Now, this has been the good news story for Canada. This is where we can compete, and this is, again, the service sector, which is where our strength is at. Yeah, that's a fundamental question for an economist. Is it supply driven or demand driven? I think it's demand driven. I think it's demand driven. I think we've had, and in fact, there's some issues as to whether we're really aligning well the skill sets from our students to the workforce. So there's a lot of questions about that. I would suggest it was demand driven in the sense that when we look at the growth patterns, it's been in engineering, it's been in financial services, it's been in insurance. These are the segments where we've done well. Accounting. Now the service sector is a very broad, often small business sector, so it's hard to get good information about what's going on. But this is certainly we can see it on the top line numbers where we've had success. But that's a great question, and it does segue well into the next piece, which is around the labor markets. And what I'd like to say about labor markets is essentially that we're talking about the baby boom exiting the labor force as though it's almost ended. And that's absolutely not true. In fact, the baby boom cohort, and you can see it today in the blue bars, the baby boom cohort is aged essentially 50 to 68. So the first baby boomers are just starting to retire now. And the first baby boomers, you can see at 68, they're a fairly small cohort. The back-end boomers, those people aged 50, 52, 53, that's the big cohort. So, I say that forecasting is hard, economic forecasting is hard, demographic forecasting is easy. You just have to age everybody one year at a time. Every year you look forward. It's really easy exercise, and you can plan very well what's going to happen with our demography by the time we get out to 2035. In other words, over the next 20 years, we're going to see more and more people exiting the workforce for retirement. It's unstoppable. It will happen, and essentially it's going to draw down the number of people in the workforce more and more over time. So what happens to overall labor force growth? And I talk to HR folks on a fairly regular basis, often enough, and the pushback I get is always, well, we don't have to worry about that because we have all of these policies. We're going to engage older workers. We're going to bring in migrants. We're going to be very competitive on our resource, on our programs, on our compensation programs. And I say, well, I do all of that too. We do all of that at a macro level, looking at the economy-wide. We have stronger immigration levels. We do keep, especially women, older women in the workforce longer because we've seen those trends. So we increase what's called participation rates in the workforce across all cohorts. We do all of these things, and despite that, the baby boom cohort is going to exit, and that means slower overall labor force growth. It's just a net basis. Even if you bring in more people, you're seeing a lot more people exit. And what does this mean? It may just look like a chart with blue bars up there, but what it means is that in the past, especially over the past the years before the recession, we were growing our workforce by about 2% a year. 1.8 over the past decade, 1.8% a year. Going forward, we're going to grow our workforce at 0.6% a year. So the pace is going to be 1/3 the pace we were used to. And this is what I say to business people and planners and organizations, is that can you manage your growth expectations and your planning with 1/3 of the gain in the workforce that you were used to in the past. And it may not be true for all businesses, but on the whole, it's true for the macro economy. Now, the other thing we're often hearing about is whether labor markets are really slack. And I would say, yes, there is some slackness in the labor market. It depends on where you're at and what professions you're looking at. But when you look at the overall unemployment rate still in Canada, we're only at 1% above, or a little bit above 1%. Well, essentially we're at 6.8% right now in terms of the unemployment rate. That's about 1% above what we feel is the underlying low unemployment rate for Canada. The last time we were there was in 2007, 2008, and we had inflationary wage pressure in some parts of the country. So we do have some gap. We do have some slack. What does it look like, and where is it at? Well, a lot of it is in terms of youth employment. We've seen a little over 200,000 jobs lost among the youth since before the recession. None of those jobs have come back. So the youth are evidently underemployed in this economy. I have one myself who's at home. Well, he's now studying, but it's a challenge. And we haven't been able to get these youths into the workforce. But 200,000 youths into the workforce, that's about 1% of the workforce. So that gap of 1% that we have now is about 200,000, the equivalent of what we have in terms of unemployed youths. If you look at where the slackness is happening across the country, all you have to do is look at where the gains have been in terms of employment growth since the recession. So we've had, again, I mentioned that reinvestment in Canada. Investment has recovered since the recession. We've seen some strong gains. And much of that is happening in those resource-rich economies, and we're seeing a lot of demand pressures for employment, Saskatchewan, Alberta in particular. Newfoundland and PEI as well have had some strong gains. But Eastern Ontario, for Ontario and Quebec and some of the maritime provinces, it has been a very challenging labor market. Here's the other piece, the temporary foreign workers. Now, it's hard to know what the stock of temporary foreign workers is in the country. We get an estimate from Immigration Canada that tells us at this point in time, I think sometime in December, we have about 500 or just shy of 500,000 people in the country. We don't know what the full-time equivalent is, or if there's, how many people are actually coming in and out of the country, and for what duration. The other thing is this is in the winter, so we know we're missing out on a lot of temporary seasonal workers that are involved in the ag sector. But let's say that we have 200 or 250,000 people on a full-time equivalent basis. That, again, is another 1% of the workforce that's represented through temporary foreign workers. This stock of workers also has to be replaced on a continual basis. So it's usually permits are for 1 or 2 years on temporary foreign workers. The stock has continuously to be replaced. So as we see the tightening up on this program, what will that mean for labor markets and for demand pressures on workers, from employers especially? Now, here's the other piece, the retirement age. It is increasing. We look at that certainly, and as I mentioned, we incorporate that into our forecast. But the point is, yes, you can leave increased retirement age, and I think some of the difficulties with the stock markets have had some impact on this. But people are living longer. I think they want to stay on the workforce longer. It is a knowledge economy. A lot of the jobs are knowledge-based, so people can work longer. But you're only delaying the inevitable. Right? If you keep more and more people into the workforce, sooner or later you'll have more and more people retiring. So this is only delaying the inevitable, and sooner or later, even those people that have delayed will retire. The other piece that tells me that the pendulum has essentially shifted towards the worker. In other words, the labor market favors workers and not employers, in the sense that real wage or the price of labor has continuously increased since 2004. So there's been a fundamental change with the demographics, with that unemployment rate getting down around 7%, that has essentially seen real wages rise. So what this chart is showing you is simply in yellow inflation, and in blue the nominal wage. And before 2004, we always tended to have inflation above nominal wages. In other words, we were eroding our purchasing power on average for workers. Since 2004, it's been the opposite. And in some years, we've seen some huge wedges, 1.5%, 1%, where the nominal wage has been above inflation. And that's great. More money to households, more purchasing power. That's been phenomenal. But if we don't keep productivity growth in line with that real wage increase, then we start to erode on competitiveness. And that's part of the reason the board, my employer, has done so much work around productivity, innovation, and some of those aspects. Yes, please.
You said earlier that productivity was largely affected by the value of the dollar. So rather than trying to lower workers' salaries, why don't you lower the value of the dollar?
Well, let me just change that. I said that productivity didn't help, but certainly the value of the dollar hurt competitiveness. I mean, we are challenged competitively with a much stronger dollar. There's also advantages to a much stronger dollar. It generally reflects a strong economy. People want in on our action, essentially. They're buying into what we have, and that raises the value of the dollar. And I think a dollar at 80, 90 cents, you know, it's a pretty good deal for most households. You feel a little more, a little wealthier, a little more purchasing power when you travel, I'm sure. So there are benefits of that. Now, the other piece is on productivity, and how does a stronger dollar, I think a stronger dollar will actually help us be more competitive, be more productive, by helping us to invest in machinery and equipment, which is cheaper when the dollar is strong, and by simply opening up to competition. You know, at 62 cents, we could produce pretty much anything and sell it. At 88 cents, you know, we have to be competitive. We have to be more productive and innovative in this country. Now, again, going back to that regional divergence, here's the cumulative gains in real wages across the country. So again, a very, very different market. If you look at what's happening in, I am running out of time, so I'm going to try and speed it along. But essentially, we've seen some very divergent growth across the country. And in Newfoundland, wages today have caught up essentially to the national average with a 40% gain over the last decade. In Ontario and Quebec, wages a little below now the national average. And Alberta, for example, still growing strongly, in fact, wages right up until the latest date, if you like, 2014. And wages now about 26, 27%. Above the national average in Alberta. So a huge boom. If you go out west, I'm sure you know, there's a very different perspective around the labor market than we are currently living in Ontario and in other, and east, I guess. Now, just a quick thing about household indebtedness. And we used to hear a lot more about this from our former governor, who was very concerned about household debt, very hawkish about what higher interest rates would do to households. But essentially, we've seen pretty good wage growth, as I mentioned, not so good on the employment growth front, but enough to maintain household income, disposable income, if you'd like. And when we look at indebtedness, it's true. And debt levels have grown. Debt levels, by the way, have been growing in Canada since the 60s. It's a structural thing that's been ongoing for many, many years. It has flattened out recently, so that is, I guess, a sign of good news for those that were worried about it. But there are assets along with this debt as well, so household assets, et cetera. So the only concern really is if there's a real estate bubble, if people feel that there's going to be some major drop in prices in real estate, then I guess there could be some concern. We don't feel that's the case, by the way. The other piece is, what is the cost of holding that debt today in terms of your disposable income? And we've never seen the cost of financing at lower rates. So yes, there's concern that as interest rates start to rise in Canada in 2015, and by the way, we don't expect rates to rise nearly as much to levels nearly as high as they used to be. We're looking at short-term rates possibly rising to 3% now from the messaging we're getting from the Bank of Canada. Yes, that will have some impact on disposable income, on people's ability to spend, but it will be slow and gradual. We have assets to back up the debt, and right now, really, the issues around this are non-existent. So there's our consumer. It's really a boring story around the consumer. It's 2% a year, it seems, but essentially holding steady. And right now, we're seeing peak sales in autos for Canada. We saw that last year. We're seeing it again next year. We expect that some of that will come off as we head into 2015. We expect real estate markets will be a little softer as we head into 2015. But again, not a huge problem for the consumer. Just a little bit of deleveraging perhaps from where we are today. So the Provincial Snapshot, I just put it up there in case there's any questions, but this strength in the West versus kind of lackluster growth in Central Canada and the East is pretty typical of what we've seen over the past decade. The only thing I'd like to point out is that we're hopeful with the U.S. recovery, with stronger export growth, with a little more strength in manufacturing and machinery and equipment exports in particular, we could see Ontario get to the national average. Ontario's been shy of the national average now for many, many years, as I'm sure you know, and a little more balanced growth for Ontario and Quebec, in fact, in 2015 because of that U.S.-led growth. anyhow, if there's any questions on this, we can come back to it in a second. I'm just going to finish off with just the implications. And again, I think the important piece here is on that labor piece. We do have temporary slack on labor markets right now. It's not going to last, and sooner or later we're going to feel that pressure again, as we did in 2007 and 2008. Adapting to that is important. We need to be more productive. We need to figure out ways to produce more with a weak domestic economy, with a tightening labor market, which means higher real wage pressures, and a fairly strong currency. And to do that, we need to be competitiveness. We need to look at competitiveness on many fronts. And again, the board has done much work on that, and if there's issues and questions about that, we can discuss it. But certainly free trade and CETA, as I'll discuss later, is, we feel, some of the answers to some of those challenges. And then last, on the fiscal, again, if there's questions on that, I'd be more than happy to talk about it. We have a federal government that's now announced to all of us that we're back in surplus. By the way, we never picked on the federal government. We believed that structurally the federal government was in good shape, even though the Parliamentary Budget Office was hitting hard on that front. It's the provinces for us that are problematic. And when we look at the healthcare budgets, again, there's been a few years of success in terms of holding healthcare budgets to 3% essentially in nominal growth. But if you think about healthcare today, all you have to do is take today's healthcare system, pour in tomorrow's demography, and what you end up is with essentially a demand-based growth that's around 5.5% a year. So we cannot keep healthcare spending, unless we find more efficient delivery, we cannot keep healthcare spending to 3% a year without creating some real demand pressures and some real pressures on the system. So on that note, I think we're right on time, Michelle, and I'd be glad to answer any questions before we take a break. Thank you. Thank you.